Hey y'all, happy Sunday. Hope you've had a great weekend so far. Today, you're going to join me as I dive into the tax brackets for 2025 and see if I can make some sense of it all. To help us better understand tax brackets, I'm going to review where the income tax came from, how it's applied, and how you can use this information to pay less in taxes in 2025. So here we go. Congress authorized the 16th Amendment in 1909, and this allowed the United States government to tax income from its citizens, entities, etc., however they made their income. There was no specific percentage or rate in the amendment, so throughout history, we've seen tax brackets change from lows of 7% to highs of even 91% of your income. Now, that was for, the highest income earners in the United States, and that was in the late 50s and early 60s. But the point I want to drive home is that tax brackets are always changing. So I've attached a resource from Fidelity linked below if you want to learn more about the history of taxes. But to bring us up to speed on taxes today, in 2021, the average taxpayer paid almost 15% of their total income to the federal government. That does not include state taxes or other taxes that could be, higher or lower depending on the city or county or state that you live in. That means that the average person paid about $1,500 for every $10,000 they made that year. If you made $60,000, that means that about $9,000 was going to federal taxes instead of into your pocket. Now, the income tax in the United States is a tiered system. That means that not all of your income is taxed at the same level. So here now is a chart from the IRS website, and that's also linked below, so you can see how income is divided up into different tax brackets. This figure is based on the 2024 tax bracket for a single income earner. If we add all of this up, this taxpayer would have paid $7,813 in federal taxes. So it's not too far from my extrapolation of about $9,000 back in 2021. Now, here are the tax rates for 2025. As you can see, the minimums rose by about 2.7%, which, if we do a little digging, is almost in line with inflation, which is approximately calculated with the Consumer Price Index, or CPI, which states that inflation in 2024 rose by about 2.9%. Now, not to tangent too much on the CPI, and I can do a whole video on that later in the future, the U.S. Department of Labor statistics updates the CPI almost monthly to see how the United States is doing with inflation just across the board on many statistics, from anything from food, utilities, you name it. A lot of the big categories are on there. So one would assume that the IRS would adjust tax brackets based on the CPI, so that if the CPI goes up a lot in inflation in the previous year, the IRS would modify their tax brackets to adjust for that cost of living increase by adjusting their income levels to go up, so that you're not paying more in tax in following years after if inflation goes up. Now, the CPI has come under a lot of fire, I guess forever, as long as it's been around, because a lot of folks argue that it leaves out some key items in their calculations, and a lot of folks also have many concerns about how it's calculated. One of the biggest things is, is it based on information from the city or from the country area or somewhere in between? And even if it was somewhere in between, is it really reflective of, the inflation folks could be seeing in those different areas? I did some small research. You can check out the article below, or that I have linked below now, that I found on the CPI from Investopedia if you'd love to learn some more information. Now, no one wants to pay more in taxes than we have to. Obviously, everyone believes in some sort of tax, because at the end of the day, these taxes go to fund things like roads, schools, bridges, highways, and a lot of essentials that all of us use. However, it should be capped at some point, because we want to keep the money that we work for and have the opportunity to invest it, save it for our kids, and so on and so forth. So we just want the freedom to do with it with what we can. We've discussed how the income tax began and how it's applied to your income. You're probably wondering when we're going to get to that third point and discuss how understanding tax brackets will help you save in taxes. And the unfortunate answer is that there really isn't much you can do. Last week we discussed deductions and credits, and we saw that for the most part, for most people, the standard deduction, whether you're single or married, is going to be your best bet. the only way to really begin saving in taxes is to find more ways to increase your deductions and or credits depending on what you're doing. And the best way to do that is owning more assets, whether it be real estate or owning a business or different businesses. And so that's why next week we're going to be discussing our next book in our book review series, The Cash Flow Quadrant by Rob Kiyosaki. And there we'll discuss different ways to bring in income so that you can learn to decrease your taxes through bringing in income from various sources. I hope y'all got something out of today. I love each and every one of you, and I'll see y'all next week where we discuss the cash flow quadrant.